Welcome to Impact Academy, the module Impact Financing Instruments, Sustainability Bonds. What are the objectives and goals? To understand the market dynamics, benefits, and challenges associated with these instruments. To define and differentiate between green bonds and social bonds. To identify regulatory frameworks and industry standards for green and social bonds. Further, we will analyze case studies and real-world examples of green bond and social bond issuances. And plus, we apply knowledge of this financing tool to support sustainable and social impact projects. In the first unit, we will have an introduction of these topics. The second, we will delve into the green bonds. Section 1, what they are, then why are they useful, and what are the green bond principles. The third unit is about social bonds. We will know what they are, what are the principles of social bonds, what's the social impact bond, and what is the SURE Success Stories Across Europe initiative. What is a bond? A bond is a financial instrument where an investor loans money to an organization, for example, government or companies. The issuer promises to pay back the loan with interest over time or repay by a specific date, maturity date. A bond is seen as a low-risk investment with predictable returns. Impact or ethical bonds, they focus on financial returns and contributing to society or the environment. They include social bonds, green bonds, or sustainability bonds. Sustainability bonds fund projects with environmental and social benefits, combine objectives of green bonds and social bonds, adhere to 4 core principles: use of proceeds, project evaluation and selection, management of proceeds reporting, contribute to Sustainable Development Goals, SDGs. What they are: debt securities to refinance environmental projects. They are issued by public bodies such as governments, supranational organizations like the World Bank, and private companies or banks. Purpose is to align financial goals with environmental values, to fund initiatives such as renewable energy, clean public transportation, sustainable water management, green buildings, climate change mitigation projects. But why are they useful? A dual benefit: returns on investment plus contribution to environmental protection. Corporate and public value: positive public image for the issuers, attracts new investors and may lower funding costs. Importance of certification: for example, ICMA Green Bond Principle, Climate Bond Initiative Standards. There are risks to consider. For example, issue reliability, yield versus duration, or greenwashing risks. The project may not deliver the intended environmental impact. Challenges: lack of a unified global standard for certification. New standards like European Green Bond Standard aim to increase transparency. Currently favored by institutional investors, but adoption among retail savers is limited. Green bonds. Green bond principle. Purpose: procedural guidelines to promote transparency and disclosure of information. Integrity in the growth of the green bond market. Key benefits: help issuers define and issue relevant green bonds. Assist investors in understanding the positive impact of their investments, and guide underwriters and financial advisors in facilitating transactions. The core emphasis is to the transparency, accuracy, and integrity in issuer reporting. 4 key components of green bonds principles. Use of proceeds. Funds must be allocated to green projects with clear environmental benefits. Benefits should be quantified and communicated by the issuer. Project evaluation and selection. Issuers must outline environmental objectives of funded projects, eligibility criteria and risk management processes. Management of proceeds. Net proceeds should be credited to a sub-account or tracked in a controlled system, documented formally in the issuer's financial processes. Reporting. Annual reports should include project details, allocated amount, and expected impact. Social bonds. What are social bonds? They are financial instruments designed to generate financial returns, tackle pressing social challenges like affordable housing, healthcare, and education. They aim to improve lives of vulnerable communities and bridge the gap between public goals and private resources. Why are they important? Dual benefit aligns social impact with financial returns. Empowering change attract investment for projects that lack traditional funding. And plus, they engage young investors. Young investors value socially conscious investments. Social bonds align financial growth with personal values. What's the future of social bonds? They are growing a role in financing sustainable social initiatives, and they provide transparency and measurable results for stakeholders. Principles of social bonds. Core principles. Use of proceeds. Funds must address social objectives, for example, healthcare, education, housing. Process for project evaluation and selection. Projects must be evaluated for social impact potential using a transparent process. Management of proceeds. Funds should be managed transparently and traceably. Reporting. Issuers must provide updates on allocation of funds and the impact of funded projects. SURE initiative. What is SURE? Support to mitigate unemployment risks in an emergency. Purpose: financial aid to EU member states during crisis. Key features: funds raised via social bonds. Support: job retention programs, employment stabilization. Achievement: 98 billion raised, benefiting millions across the EU. They helped stabilize economies and blueprint for future economic crises. Summing up, sustainability bonds and impact entrepreneurship. Why they matter. ESG principles build stronger reputation with investors and consumers. Power of sustainable bonds contribute to a better future, build businesses with lasting societal impact. Opportunities for entrepreneurs. They combine social environmental well-being with profitability and attract funding through sustainable bonds, plus the SURE initiative that support to mitigate unemployment risk in an emergency.